Hello and welcome to the first Fixnar in the 2021 Americas series. This Fixnar is kindly sponsored by Triana. Before I hand over to Lawrence Jones, who is also Global Co-Chair for the PostTrade Working Group, I have some housekeeping bits to do. This Fixnar will be governed under the Chatham House ruling, which means no quotes or recordings without permission. Should you wish to raise a question during the session, please use the Q&A button at the bottom of your Zoom screen. Towards the end of the Fixnar, you'll be offered the opportunity to raise your hand if you would like to unmute your mic and ask a question directly to the panel. Over to you, Lawrence.
Thank you, Naomi, and welcome everyone to, as Naomi said, the first Fixnar of 2021. First of many, I'm sure, as we continue to remain in kind of the remote working landscape that we're in just a little bit longer. Also, very quickly, as Naomi said, we do have a Q&A. If you have any questions, please do submit those real time. We may not answer them real time, but if you have something that comes up, please do send it through and we'll make sure that we get to that question. So just a little bit of an introduction. I'll do myself and then we'll go through the other panelists. So my name is Lawrence Jones. I work in post-trade strategy at Triana. So I manage really all of our, what we call our payment and settlement optimization products. And I also manage a host of our FX prime brokerage products. Based out of the New York office, or well, on days when we're usually allowed in the office, typically I'll be in the New York office. And I'm also the co-chair of the Global Post-Trade Working Group here at Fix, and I sit on the Americas board of Fix. Lou, you want to go next?
Thank you, Lawrence, and good morning, good afternoon. Thank you for having us today. Lou Rosado from Block Operation Strategy and managing our industry relationships. Glad to be here today. Thank you.
Sure. Then Alison.
Hello. Thanks for having me here today. I currently work at Citi Group, client relationship from an operational perspective on strategy, as well as managing some of our middle office operations teams. I think really our biggest focus here today is working on partnerships and expanding the Fix relationship across the board. Thank you.
Excellent, thank you. And last but not least, Matthew.
Hi, yeah, thanks. My current role at OCC is leading our securities lending product line, enhancing and growing that. My history of Fix actually goes back quite a long time. I spent a lot of time working with exchanges and particularly developing the first round of Fix ML support for the listed derivatives industry. Glad to be here.
Excellent, thank you. No, thank you to all the panelists for being here today. So just a quick thing on Triana, as we are the lead sponsor. Just wanted to give a little bit of context, a couple of minutes on kind of Triana, who we are, because I think some people on this call may not be as familiar with us, but I'll keep it brief. I definitely won't go too heavy on a sales pitch. But for those of you that aren't familiar with Triana, we have been and do remain at the forefront of the post-trade space for about 20 years now. We've kind of evolved through the equities space into OTC, into FX, right the way through into CFD and ETD, and we're very big users of Fix. You know, we leverage some trade allocation confirmation messaging workflow, and even more notably, some of the new products that we're looking to leverage it through in the payment and settlement space off the back of the new Fix messaging spec. Got a huge network, very expansive set of products. So if anyone wants any information on kind of Triana, please, and I'll be more than happy to kind of hook you up with the right people. So we've got a couple of key areas that we want to get through today. And a couple of things we want to touch on, but I think it'd be good just to do a little bit on kind of lessons learned from 2020. So I don't want to dwell too much on 2020. I think a lot of people would probably like to forget 2020, but I think there's definitely some good lessons learned that come out of 2020. And how do we think firms will continue to kind of deal with the impact the pandemic is still having as we move into kind of 2021 and beyond? So I'm not sure which one of you wants to take that first. More than happy for one of you to jump in, or I can pick someone.
I'm happy to start. I would say I'd highlight kind of three main lessons. First would be cyber is a continual threat. Second would be, workflow and automation. We need to greater automation. And third, the treasury function really needs to be agile. On that first point, we saw in 2020 a lot of new and novel cyber threats emerge, whether it was bad actors making false unemployment claims. There were a number of new zero-day vulnerabilities discovered, and innumerable COVID-related phishing schemes. So we need to remain vigilant constantly. The second, around automation, I think many firms were somewhat surprised to discover how productive all of our workers were working remotely. I know at OCC we handled record volumes with 98% of our staff working remotely. But one thing was, it's easy when you're sitting 3 feet away from each other to say, hey, can you check this for me? Or can you take care of this? But when you're working remotely, it's much more difficult. So workflow automation is a theme. And then finally, we saw record volumes and volatility, which drove higher margin requirements and much more volatility in those margin requirements. So the treasury function in particular needed to centralize collateral, be able to deploy that very efficiently, and have a lot of good, quick backup credit facilities.
Yeah, no, all very valid points, and would definitely agree with you on a number of those, particularly when you talk about automation, you talk about a lot of the manual processes. I think what we saw, and as being a vendor, typically people will come to us for automation. They wouldn't come to us for a specific manual process. So we, through Q2, Q3, we saw a big influx in people looking to move away from some of those manual processes, because to your point, Matthew, if you had 98% of your staff working remotely, some of those manual processes where you used to be able to look over someone's shoulder or ask someone to validate your work becomes now a complex email process with screenshots. It just becomes even more onerous from an operational perspective. So I definitely agree that the strain on manual process and the understanding that it's not as scalable and no longer really sustainable as we move into this new age of these peaks of volatility, which I don't think are going to shy away anytime soon.
I agree. I think from the Citi standpoint, I think one of the biggest focuses has been on those manual pain points and utilizing some of the tools. Like I know it's later in our discussion, but talking about payments, by moving that over to fixed, we've eliminated a lot of manual pain points, a lot of touch points that we didn't have to do anymore. And I think that really became prevalent when everyone's working from home, adjusting to potentially maybe not having 4 monitors, having 1 or 2, and kind of reworking themselves. I think that was a big part of what we've learned from COVID is how critical some of these processes are in order for us to adapt. I think the other big things for us was connections with our clients, connections with people across the street, utilizing the tools available like Symphony to have chat rooms and to open communication. All that was so critical for us to stay abreast to what was happening and what was the key issues going on with our clients. And I think lastly, really understanding our volumes, looking at it, understanding, how are we going to make sure that if there was an increase in volumes, how can we have the right staffing in that team to really manage those massive increases, and utilizing, we have a tool here at Citi that really understands our email communication. So understanding how many emails are coming in, what seems to be the problem, how can we realign staff? So really focusing on the data and utilizing our tools was probably the overall biggest lesson that came from us.
Right. And Lou, I'm sure.
Yeah, thanks. And I'll round that off, and I would echo what Matt and Allison just touched on. We always have a major focus on what we call RSP, resiliency, stability, and performance of our platform. And so the continuous investment in resiliency, not just from a platform, but an operating model, and the effectiveness of our people when they're working in different locations to extreme we are, especially now, has always been a major investment and a continuous investment. And, you layer in cyber into that conversation, obviously that's never going to go away. Hopefully we will protect and put the fortress around our businesses so that that's not an impact negatively. But major investment continues there. Automation, thematically, that's why we're here today. How we drive automation further into the life cycle to reconnect or connect where disparate flows today. Things are actually connected from an investment process standpoint. are very disconnected when it comes to how we interact across our ecosystem. And then finding linkage, driving automation into four walls inside your workflow, but also then allowing it to connect more seamlessly externally, we learned was very valuable. Where we did that earlier, we got the benefits through the last year. We saw more value created from that. Where manual processing or that disconnect lives today, we highlight it and we learned that it's where we struggled the most in the industry together, and we got to build those connections so that our systems, our processes are more interoperable. And and Fix is one way to do that. It's not necessarily something we learned that was new, but there's an old saying, in investment management or asset management, the assets go up and down in the elevator. So it's the people that kept us through the difficult times in the last year. It's our talent. It's not just a talent inside the four walls of BlackRock. It's the ecosystem, our counterparties and brokers like Allison or custodians, the utilities like Matt's organization. Bringing together people in line with the automation was very critical. We were very, very happy and not entirely surprised, but we validated that our engagement and our connectivity through our relationships and our partnerships, like Allison highlighted, were very deep. We rallied as an industry, and our client focus never wavered. It actually increased. And go back to Matt's point on finding new balance sheet or credit and financing activity, the client needs of an individual investor. The reason why BlackRock exists today were really heightened. They had more issues or challenges, and we had to create more solutions during the last year. And that was done very successfully through, I think, a combination of all these things. If you round it off, resiliency, automation, people brought that all together.
Excellent. No, thank you. Some very good topics there, and obviously some consistency as well, I think, across everyone's own views. Some key points that were clearly relevant across all of us, whether you're buy side, sell side, utility, or a vendor. So we'll get on to the next question, payment and settlement landscape. Now, there's a lot going on here. I know this is a very hot topic for a few people on this panel. And I think if we just go back a little bit of history, 2019, Fix launched a new message called Pay Management, which facilitates really the communication and confirmation of a periodic payment. When I say periodic payment, think, coupon, swap, you've got dividends, you've got swap resets, you can go right the way through into the set lending and manufactured income space. There's 70 plus cash flows that this messaging can support. We're now looking to expand that further down into the phase 2 to take that further down the workflow into netting and instruction and real-time settlement status for both cash and securities. So I know a lot of us have a lot of interest in this piece. I know we've probably covered it from slightly different angles. So I'm not sure, Alison, if you maybe want to kind of kick off your views on it, and then we can go round, myself, Lou, and if Matt has anything to add to it.
Yeah, sure. So I think, for us, this is one of the main reasons why we're interested in this kind of forum and hoping to really expand the adoption across the industry in this. We, with the help of BlackRock, really pushed ourselves forward and moved ahead and started going live in payments. We have 4 different types of payments live today. We're going to be testing and hopefully going live with another one at the start of April. And what we've seen in this space is, there's no reason why we have to stay in this archaic way of sharing spreadsheets and, sending emails back and forth, which obviously in this environment as well has led to more mistakes, more misses, more frustrations across the board. And there's a tool available for us to use to automate it. So we should be using it, right? I think it's as simple as that. And I think that, obviously it's created a ton of efficiencies in our world. We have teams just devoted to managing payments for asset servicing for, our manufactured income space. So, we can have them doing other things that are going to be better use of their time. So I think that's one of the biggest components of this. And the other piece of this is, as we're talking in the settlement space, we're moving closer and closer to that T0 settlement, and we need to be utilizing Fix to the best of our advantage, really using it in the full life cycle of a trade and not just sticking with keeping it in silos, in regards to, this is front office, this is middle office, this is settlements, and really using it throughout the full life cycle. I think that's really where we see the benefits of Fix in the post-trade workflow.
Yeah, I would add So I think you look back, the fixed community, which really originated, plus almost 30 years ago now, major investment out of the gate to standardize messaging to digitize trading. And effectively that took root with a focus on equity. It was simpler in a listed market, in a mature market like the equity market, to bring a format that the participants, whether you're a broker, a client, or a custodian, the exchange itself, could materialize the benefit from a standard set of data or formats. And so, it accelerated very successfully the electronic trading phenomenon. Today, FIX, from a trading standpoint, supports almost every single asset class, or has evolved and morphed into things like FIXML or the variation of messages out there, whether it's FPML or FIX separately, to be able to support interest rate swaps or credit default swaps, bilateral or cleared swaps. Like the idea of using FIX to maximize and or digitize and automate trading was very successful. Allison kind of highlights the adoption, though, when we got to PostTrade was very limited over time in the early stages, especially. A placement, or an order and execution, now an allocation and a confirmation, actually were developed all around the same time. They just weren't widely adopted. And there's reasons why at those points in time that wasn't the case. But the idea here was to link then and maximize the use of that pre-existing messaging. It is a format. It's consistent with the upfront activity where a trade originates. So it naturally is very similar to when you move to then an allocation, a confirmation, and now a payment as an example. It's really just maximizing further the original reason why FIX was created, and then recouping more of that original investment in new ways through the life cycle. And it then drives that automation and connectivity that we talked about earlier. It's linking through the life cycle now, all that activity. And if we looked at it from a trade date point of view to then post-trade, payments would be just a natural extension of then asset sourcing activity when we hold a position. And in a variety of ways that you described, in 27 different payment types across the different business channels that a broker, a client, a utility, a prime broker, clearing broker, exchange, beyond then to a custodian could be better linked and connected. So, for us, it feels like a natural progression. Most firms don't, maybe early on, there's a limited number of firms that understand that and can invest in the benefit. But I think the good news is once that happens, then there's a broader access to a lot of firms to recycle that and recoup investment that the industry's brought out, not just BlackRock or Citi or the OCC as an example. It's available to the broader community now to use it in a creative or intelligent way to link their transactions and into their ecosystem to process payments. I'll just stop there and just, move to the next thing you'll probably talk about is like, now we're in a phase where we can, the message that was published in July of 2019 can evolve to very easily then to add either new payment types or things like netting or aggregation. And then take securities messaging and payments messaging through the life cycle to finality with a settlement status message, which will really complete the full life cycle and align with things like CSDR, other regulatory areas of focus, or just the overall automation and improvement of the linkage of the automation to originate a transaction and take it to finality. Whether that's a cash product or a derivative, really it's the same idea.
Yeah, no, thanks for that, Lou. And yeah, couldn't agree more on some of those points. Just to touch back on the future phases. So that has been approved internally at FIX for the governance committee for us to push on and kind of finalize the messaging for, as Lou said, the netting, the aggregation, the settlement status, cash securities. So that work is in flight. So we have some pretty aggressive targets to get that out to the community, but we fully expect that to be something that will be used this year and will roll out hopefully as quick as the original payment messaging did. We've definitely seen a big uptick in the use of the original messaging. To Alison's point, they're using it for a number of different cash flows. We're using it for a much probably a bit wider number of cash flows across a very wide set of currencies. And we're doing that on a real time or a batch basis. As a vendor, a little bit different because we sit in the middle of people like a Lou or like an Alison. So we obviously have a slightly different take on it. But the kind of the net positive is that people are using it. People are starting to realize those efficiencies that can be gained, like Alison said. If you had a dedicated team of individuals sat there doing this process day in, day out, you can reallocate that resource to something more meaningful effectively, and just automate as much of this process as you can and have the triggers and the responses back and kind of the operational oversight points. And I think Fix has done a great job of setting standards to allow that to be adopted. I think, you know, the Fix messaging, it's real time, it's bi-directional. To your point, Lou, it's cross-asset, it goes through the post-trade lifecycle right the way down now into what we're looking at in the settlement space. So I think Fix has done a great job, and hopefully others that are watching this on the call will hopefully get a better understanding and a bit more comfort that it can be used and is being used daily today in production.
One quick soundbite on something you said I just want to add to. It's really important to point out. Fix is an open protocol. We can connect point to point. We can connect through third-party connections. It's industry neutral and interoperable to a variety of platforms in many ways, whether that's between a client and broker directly and or through other third-party platforms. So I think it's critical that it's continuously highlighted. It's an open protocol, and there's multiple ways where you can connect using that format and make it also compatible with other messages that need to be integrated or normalized over time and can be more interchangeable directly. So I think that's a good point you made.
Yeah, the interoperability as well, I think is a key point there. So I'm not sure, Matthew, if you had anything to add on that, or if we want to jump on to the kind of next question that focuses on equities.
Yeah, no, I don't have much to add. You know, OCC's long been a supporter of Fix. And to Lou's point, you know, we do support a number of different engagement models, but, you know, Fix is definitely our most recommended approach because it has the greatest amount of automation.
Excellent. Okay, perfect. So on to the next question. So I think everyone's fully aware there's been a lot going on in kind of the US equities markets recently. I think we, you know, as Matt, you touched on, that there was some sharp rises in volumes through 2020. We now have what's being called like a new type of retail trader. There's a new type of stocks that people are trading, you know, meme stocks, you know, people looking at bringing settlement to a tier 0 settlement, all of these things that are kind of going on in the equity space right now. How do we think this plays into Fix, and kind of how do we think people can really benefit from kind of this change in landscape, so to speak, within the equities markets?
So I'll get started. You know, I think this is the most interesting fact. You know, on Friday, January 15th, OCC's daily cleared volume of equity and index options exceeded 50 million contracts in a day for the first time in our history. It took us 47 years and 8 months to get to that 50 million mark. And within just 2 weeks, we broke 60 million in a day. Just the growth has been phenomenal. You know, during 2020, we cleared 7.5 billion contracts, which is our biggest year on record, beating the previous top year in 2018 with 5.2 billion. So there's been significant growth. And on top of all of that volume, you know, we saw volatility that's not been seen since the financial crisis. So, you know, it was unprecedented in so many ways. And it's looking like 21 is just continuing that trend. You know, January was up like 61% as opposed to the prior year. And last month was 45% greater than the previous year. So there's certainly increased volume. And, you know, when you talk about the rise of retail traders, you know, if you look at the percentage of our total volume that is in smaller trade sizes, so I'm thinking about like one lot, single contract trades. In 2019, that made up about 2% of our total volume. In 2020, that doubled to 4%. And that's on top of that, nearly 70% increase compared to 2019. So there's no doubt that, retail had a significant role in that increase. And then, bringing it back to fix, I think what many firms experienced was those extreme levels of volume and volatility strained the practice of one firm executing a trade and then giving it up to another clearing firm. Fix certainly has support for this practice, but as we've mentioned before, it isn't fully adopted across the entire industry. And so I think many firms, especially those that weren't highly automated, struggled with that give up process and are now looking at adopting more fix and greater automation towards to deal with it. And, if I could just drill down on that process for a second, because I don't know if it's fully understood how complicated it is. First you've got a trade occurring at exchange. They pass that to a CCP. The CCP then passes the confirm to the executing firm. The executing firm then relays that trade down to the client. The client has to reconcile it and then communicate back up to their executing firm. The executing firm then has to communicate to the CCP to give up the trade. CCP tells the carrying firm, do you want this trade? The carrying firm has to claim it. There's another message. And then the carrying firm has to convey the trade back down to the client. And so all of those interactions, take time, and particularly at that lowest level with the clients, often isn't standardized. And so I think, the industry is looking at this process and trying to find ways to streamline it. Because with this increased volumes, that many steps in the process is a real challenge. And I think, we'll see, growth within the use of fix, but also adoption and changes to the fix process as the industry tries to streamline that.
Perfect. No, thanks for that. Thanks for that overview, Matthew. I'm not sure if anyone else has anything they want to kind of add into the equity space, the concept of, T0 settlement and kind of what that really is going to mean and how long people think that's going to, the aspirational target to be achieved.
Alison, you want to go first? I have an idea on that, a few thoughts.
I mean, everything seems to take longer than we think. Or it should, I guess. Right. I think there was a couple things I think that Matt said that I think have a lot of impact, right? Is, talking about all the steps to the process and the need to kind of standardize what's happening internally and externally, right? So creating a standardization across the board, front to back, is always going to make everything seamless, and it's going to better prepare us for the next phases of reducing that settlement cycle and having the full SSIs on our messages, making sure that we're not storing stuff in different locations and then trying to look it up, and all those unnecessary, roadblocks that can slow something down within the full life cycle can be eliminated by really utilizing fixed messaging to its full capabilities. And I think that's really the direction that we're going into. I don't really think I have an indication yet as to, necessarily when we're actually going to get there. It's kind of archaic to think that we're not already there yet, but hopefully it will soon be there. I know obviously we'll go to the T1 and then down to the T0, but in order for us to get there, we have to standardize what's happening within our firms and across the street and really utilize the tools that are out there rather than keep relying on these older systems that aren't really going to be as efficient.
If you start back on Matt's, the volume and the volatility increases, right, that we experienced last year around the same time, through that period of time, then in multiple ways or forms through very recently now, and greater regulatory attention on that naturally. I mean, up through this week, obviously, whether it's the regulators themselves or Congress. There's a high-class problem that we're all dealing with, that the access to healthcare and the amount, technology is allowing us to live longer. And because we need to live longer, then, or we're going to live longer, or we need money to live longer. And so the investing public, whether you're retail or institutional, has been growing and trending for many, many years. So we're going to see a continuous increase in volume of investor needs and solutions in the marketplace, the things that we do to solve the investment public's goals and needs. And so volume and volatility is going to only continue. It's not going to decrease, I think, over time. And really then you get down to, if we're talking about equity as an example, where we started this, a very mature listed market, you would think naturally there's a high degree of efficiency in that marketplace. There is, processing and automation and risk management that's very, very tight in that marketplace. We expand into the listed market beyond just equities to then futures and options or other derivatives. There's still a major problem in the plumbing. The lack of connectivity from the exchange, like Matt just talked about, through to then the broker, then to the client, back to the clearing broker or clearing utilities, is really, really amazing today when you think about how far technology is actually advanced, and there's still some disconnect in that very mature, very automated marketplace. And so I think, like, at the end of the day, FIX is one way to connect those things together. It's not widely adopted or understood yet that there is a connection between an order and execution down the exchange, then back to the allocation and the give up processing, through the margin movement or collateral and margin movements to the reconciliations, then to keep the investment books of record and the clearing books of record all aligned throughout that life cycle. And I think the industry is going to get more pressure to solve this problem. The regulatory regimes have already put in motion things like, for the cash market, CSDR, or now the entertaining idea of moving from T2 to T1, or maybe someday T0, and getting there in a variety of ways. And I think there's very disruptive things that could come into that equation, but really there's a lot of pre-existing investment in things like FIX that could be helping us achieve more real-time or intermediate-term solutions throughout that journey. So I think it's really, I'm not looking for more regulatory pressure, but I think at the end of the day, we have an opportunity here to get ahead of that and be proactive before a regulator, the CFTC or the SEC comes in and tells us what to do. And some of that low-hanging fruit, Matt, I think clearly you're instrumental in bringing us together in that idea. And Allison, obviously, our full ecosystem of broker partners, custodians, and investment management clients, have a role to play in this and need to accelerate their active participation in making this problem get solved.
Excellent. No, perfect responses all round. So I know we're just about to have a question pop up. I'm a little bit cautious of time because I know we've only got about 10 minutes left. So there's a poll question that's just popped up for everyone in the audience. If you could complete that, that would be great. I don't think we can vote. I can see Lou frantically trying to pick his selection.
I would select them all at this point, but thank you.
Oh no, they're all.
Yeah, we needed a D, all of the above.
Yeah, that's not a bad shout. So 64% automate as much manual processing as possible, maintain consistency through the full life cycle, leverage fixed standards as much as possible. I mean, you could almost say they all come hand in hand, that if you leverage fixed standards, then you effectively automate a lot of the manual processing that you have there today, and you would maintain some level of consistency throughout the full life cycle and ecosystem. Not sure if anyone else has any kind of quick views on that, or if that's pretty standard as what you were going to expect to see.
Well, just think in terms of what Matt just highlighted in the give up flows. There's a lot of automation through execution all the way down to clearing, but there's still manual processing that is in between all that. It's not very connected through the automation that exists in each vertical. It's not horizontally connected enough today. And then you move into automation through the life cycle. Well, that's the same problem that number one item was highlighting there, right? And then you move down to FIX as a solution to solve those other two things. So I think they're all interrelated and really the same problem and opportunity to solve.
Always an opportunity, Lou. Always an opportunity. So the last question that we just want to go over is on repo and sec lending. So there's also a lot of stuff going on in that space in the fixed community. I know we have a repo working group, I think we have a sec lending working group, and also there's a lot that plays into the payment side where we're looking at bringing in the cash flow aspect of sec lending and manufactured income as well. And I know, Matt, I think you had a couple of things you wanted to touch on specifically kind of in this space on the repo and sec lending space and what's going on in fix.
Yeah, absolutely. Lou highlighted well the sort of adoption of fix, first started in the equities market, then moved into the listed derivatives markets, expanded into some of the swaps markets, particularly cleared. Securities lending has not widely adopted fix at all. In fact, there really isn't good industry standards. Pretty much it's bespoke communications to every one of your counterparts, which of course, causes a high startup cost as well as maintenance costs, and it really stifles innovation. So, like just to give an example, when a lender wants to express what their inventory is that they want to lend, they want to put that out into as many different channels, onto as many different trading platforms as they can, attract as many borrowers to compete for that inventory. But as they send out these messages about their inventory, it's in a different format to every different trading platform. And anytime that there's a change to that inventory, whether it be, some shares got borrowed or additional shares became available, there isn't a common standard for how you then update your inventory on those different platforms. So, that's a very expensive process to manage, and it makes it very difficult to adapt to new trading platforms. The back office has its own struggles as well. Most firms have more staff in the back office, which is a cost center, manually managing reconciliation of errors every single day. More staff than they have traders actually in a profit center generating revenue. Last year we did a survey of many participants, and the majority said they're spending between $1.5 to $5 million a year alone on that reconciliation process. So, it's an area that we've really been focusing on to try and improve the accuracy and automation of that information. So we have a fixed working group that's been focused on that. We're looking at the full life cycle. So in the pre-trade space, looking at messaging for expressing that lettable inventory or borrowers showing their interest in borrowing. In the trading space, through the negotiation process and confirming trades. And then particularly in the post-trade space of confirming settlement, daily expression of contracts, and all of the life cycle events that occur on those contracts. And, we really believe that if we can get adoption of these standards, it'll really bring much more automation. It'll bring down the number of breaks and the cost of managing those breaks, because it is such an expensive and manual process. It'll increase utilization because lenders can express their inventory to more and more trading platforms. That'll improve rates, growing profits within the sec lending desks. And, that could really have a benefit to all investors. This particular sec lending is an important way of subsidizing both ETF issuance as well as just brokerages as they race to the bottom on fees. So we really hope that the industry engages. Anybody is welcome on the sec lending working group to help contribute.
Excellent. I'm not sure if anyone else has anything else to add from a repo or sec lending perspective. Lou or Ellison?
Listen, as a large agent lender, and being part of that broader ecosystem. I think, like, really at the end of the day, the market structure today, the liquidity produced from lending is very important, and we know that. And the risk, though, in managing all that activity, from a locate to an actual trade or loan to recall, to manage corporate actions, that process simple things like reclaims or manufactured income, are very, very disparate today on how we do that. They're not at the highest level of SDP and or interoperability, and so operations we don't always consider. Maybe probably don't overtly say we're risk managers, but we are. If you're a risk manager here in this conversation, you're fidgeting around in your chair. You're very uneasy because you know what the pain points are through all of what Matt described. So there needs to be an acceleration to automate and do it in some standard way, so that all firms that fit into that ecosystem can connect to some degree in a standard way. Standards don't fit everybody's business needs or proprietary system and automation tools, but they allow for some interplay that's, at least concentrates where some firms can pick that up and then spread some of that out and, get creative with third-party connections to adopt some of that for data normalization or some level of interoperability. So securities lending is starving for a lot of what we're talking about. Matt, you couldn't have highlighted it better. Thank you.
Yeah, I agree with both Lou and Matt. I think these are the, two archaic processes, repo and sec lending, that, need some much needed help. I manage all of our repo processes from an operational perspective here at Citi. And so I feel that on a daily basis. And I think these are really things that we need to continue to move forward. So I'm excited to see, the continued work happening within these individual working groups. And I hope that this call encourages others to, join in and get involved and start taking up some adoption.
The repo financing activity, to Allison, to your point, think about this. We know that, going back to the earlier comments from all of us, we are digitizing electronic trading of repo today, but post-trade is not in sync or in parallel to the effort to digitize the repo trading market. It's an easy, to me, it feels like low-hanging fruit that we would just carry over. If we're able to execute that way for repo, whether that's tri-party or bilateral, then why won't we naturally be able to allocate, confirm, or process post-trade down to a settled transaction? Or, naturally, because repo is more complicated with the collateral and the term repo than the life cycle events that come off of that transaction, which really, again, are even further disparate and or manual in nature in terms of how we have to support all that. Thanks for pointing that out, Allison.
Excellent. So we have almost come up to time. We have had a question come through. Well, it kind of looks a little bit more like a statement, but it relates to sec lending. So I'm reading out. It says, regarding sec lend, historically in fixed, there had been fits and starts going back to the days of the Bond Market Association, but it didn't get far. So I guess we're probably in a bit of a different situation now, I would assume, and I think maybe that question is more alluding to the fact that, do we think we're going to have the same kind of problems, that it won't actually materialize, or that this time it's a little bit different? We've obviously evolved a lot since the historical days of the bond market.
Yeah, and I think we're seeing much more engagement on the working group because this sec lending and repo is a very, very important way of funding and generating revenue within firms at much more greater levels than it was in the past. So the pressure to create automation through the entire life cycle is stronger than it has ever been in the past.
Excellent.
And the last year has actually highlighted that even further, where parts of the industry haven't advanced, whether that's give up processing or areas like sec lending and repo that need additional automation through the life cycle. So I think there's actually an acceleration of those things. I mean, to start a call, you mentioned payments, Lawrence, and the idea that we're using that message now to allocate, confirm, reconcile through to settlement a manufactured income transaction. That's embedded in our sec lending book, and firms are doing that now. So you're going to see it'll move up and down the life cycle in terms of where fixes start to fit in. Naturally, the trading piece is there for repo. I would venture to think, you're going to see similarly opportunities for the trading of sec lending then through the post-trade and life cycle.
Yeah, no, agreed. We have just had one other question come through. I'll try and get through it quickly. So do you think blockchain could be utilized to achieve instant settlement, and how does FIX protocol fit into this? So I'm definitely no blockchain expert. I think I hold some Bitcoin. That's probably as aggressive as I would get on blockchain. I know we do have a dedicated digital assets group within FIX, right?
Yeah, I think that they're complementary. We're currently in the process of building out a DLT-based securities lending platform, and we want to do that roll it out in a way that is complementary and supportive of the automation the industry has already built through accepting fixed bill messages, which creates greater connectivity. But the DLT really helps with the synchronization of that information. So, FIX can be the input to driving changes on the ledger, and then the ledger is helping to keep people in sync more continuously during the life cycle of the contracts.
And there's we're moving past the point of use cases or pilots to now actual real production uses of a distributed ledger to allow for post-trade activity to be captured on the ledger and then move and be interoperable between a client or a broker or a prime broker. I think that you're going to see more of that. And Matt, I think you're right. I mean, this is a way to recoup investment in your prior investment in FIX to be the on-ramp, off-ramp. And then over time, I think other forms of messaging might evolve, but they'll fit into we can fit into today that move data for an equity swap or for a futures contract or lending activity within that distributed ledger idea or platform or place where that truth lives when we're moving data to and from our own interoperable workflows.
Yeah, I agree. I mean, I think ultimately, sometimes people may think that it's something so complicated, a fixed message, but it's purely a message, right? So it doesn't have to be so complicated, and it can be used in hundreds of different forms. So there's no reason why it can't be utilized to help support a lot of these other initiatives that, I know Citi has a lot of initiatives going on across the industry, focusing on blockchain and really how that can improve the post-trade workflow and how we can be more efficient. And so fixed messaging is just another part of that piece that people can utilize to send and receive messages. I think it's as simple as that.
Lars, just one more point. It's not a matter of these things competing with each other. It's a point in time when they converge. So, DLT will have a lot of promise, and it's going to happen. It's happening. At the point in time that replaces things, though, is probably a longer term off. So it's a matter of how these pieces of the puzzle fit together. And actually, I think there's a great convergence of these things over time. So it's multiple solutions that bring together these really higher level concepts.
Yeah, no, all sounds good. All sounds good. I used to be very negative some of the blockchain stuff, but now I seem to be coming around a little bit more to it. Maybe the Bitcoin got me and the meme stocks. So I'm not sure if anyone has anything else they want to get off. I know Kathleen was going to do a quick little thing at the end from the fixed trading community. So if we don't have anything else, obviously thank you to the other panelists for joining. Hopefully everyone found that very useful, and we can let Kathleen just kind of do a little bit of a couple of minutes at the end.
Great, thanks Lawrence. And thank you to all the panelists. Appreciate your perspective and expertise on the topic, and also providing us with insight into specific areas of focus. Right now, you'll see the slide on the FIX initiatives, and these are just a couple of the active groups within FIX, but two specific topics that were referenced during today's call was post-trade and securities lending. and they're actively being addressed by the working groups. And as Lawrence mentioned, the post-trade working group is moving into a phase 2, focused on driving automation further down the post-trade chain, addressing netting and settlement instructions. And as Matt referenced, the securities lending working group, they're developing a standard set of securities lending messages. The initial scope will be on post-trade and clearing. So these groups are both just 2 examples of groups that are driving automation, and at the end of the day will lower risk, cost, and increase efficiencies for the industry. So we encourage you to visit the initiatives page on the website and to contact the program office or register on the site and request to join a group and get more involved in these topics as they evolve. So Naomi, we'll move on to the next slide on events. And so this slide here, just a snapshot of our global events. And you can, of course, get more information on the website on the events page. But just to highlight what we have coming up in the Americas region, there are a couple of webinars in the queue. The first one on the next one on the 29th of April is Emerging Technologies. And then we will have an OMS-EMS series between May and July, and those dates are yet to be determined. But again, just go onto the website and look at the events that are listed there and join them. So that's going to wrap up the end here. I want to thank Triana again for hosting and our speakers and everybody who was able to join us today. Stay safe and have a good day, everybody.